day, everyone. Thank you for joining us once again here at Seafood and Brew for our economic briefing. I am Jamie Sumner, Chief Analyst, and for this briefing, we want to review over our second quarter performance of the Community Bank Benchmark Group. Overall, when we look at the return on average assets, we can see for the second quarter, we're up to 1.17, up from where we were last quarter at 1.11, and 12 months ago for the second quarter 2018 at a 1.16. So up slightly overall when we look at the return on average assets. When we break this number down into the subgroups that we utilize for our performance risk reports, the subchapter S, the stocks, and the mutual institutions, we can see overall consistent trends all across the board, up year over year in terms of performance on the return on average assets, 153 for that average or the median for those sub-S institutions. If you recall, those sub-S institutions are pretty much exempt from taxes on the federal level and in some states. But overall, when we look at the stock institutions, they're at 1.11, up from 105 in the second quarter. And then we look at that mutual institution group, and they're at 63 basis points up 1 basis point year over year and 3 basis points quarter over quarter. So they continue to be a solid performer there, while they're below both the sub-S peer group and that stock peer group. They just run a different type of business model at those mutual institutions, and that's where we see their overall return on average assets. Now, if we break this down into the different components of that return, we can see overall net interest margin picked up for the second quarter, and we can see that at 3.82% for that second quarter, up from where it was in the first quarter at 3.78. However, at 3.78, we have to recall that that's a short quarter. There's not as many days of interest being calculated there, so we have that to take into consideration. But year over year, we can see we're down by 1 basis point, and that's the big question as we move through the second half of 2019. Will we see this margin compression come to fruition when we see, as we look at the overall level of interest rates? And they have been falling over the past several months, more recently, significantly over the past couple of weeks. So net interest margin is something that we're going to have to keep our eye on. And when we look at the two components of net interest margin, the yield on earning assets and the cost of funds, we can see yield on earning assets up from where we were in that first quarter, and we're up 8 basis points to that 4.69. This is going to have a lot of sensitivity to that movement in rates that we've seen. We saw the Fed come down in their Fed funds rate by 25 basis points. That's going to impact those short-term rates, and in terms of those repricing of those perhaps ARMs or any type of loan that you have, repricing is automatically going to be hit 25 basis points. And then you look at the long end of the curve, down substantially with that 10-year Treasury going below that 160 mark, and that's going to give us some pause in terms of our longer term assets, fixed rate assets, where we're looking at our investments and our loan portfolio, those mortgages getting down to the rates where it will be advantageous for some customers to start refinancing. So we have to keep an eye on that and how that's going to impact that overall yielding earning assets throughout the second half of 2019 and then into 2020. But cost of funds, we should see a benefit on the cost of funds as we move forward, most likely in the fourth quarter, not so much in the third quarter. I do see the possibility of those yielding earning or the cost of funds increasing slightly through the third quarter, but then pulling off maybe in the fourth quarter or the first quarter of 2020. So that cost of funds, just you can see that trajectory continuing to climb. When we look at the cost of interest-bearing deposits, so this is taking out all of the borrowings and just looking at that deposit number, we can see that we're up to 1.15. This is where that relief is going to take hold in the fourth quarter and the first quarter of 2020. We should begin to see this number come off a little bit. When we look at the overall type of deposits, so you got the cash type deposit, these are your non-maturity deposits. We can see this overall level dropping down to 70.56. This is due to customers flowing into that CD market to take advantage of those higher rates on CDs. We've seen that kind of cap out. We'll start to see those CD specials reduce in here, and hopefully we can see some stabilization of this. But historically, we're still at pretty robust numbers when we're looking at this cash type deposits, the total deposit number. And remember, this is where the value of the institution is created with that deposit premiums. Overall loan growth, though, we can see has slowed down to just under 1% for the second quarter. And this is the aggregate loans. This is all loans in this benchmark group. So that overall loan portfolio grew just 0.92%. And we know we've seen the vast competition out there in the market. It's continuing to become difficult, more difficult to get solid loans at decent rates. So it'd be interesting to hear from you all if you're seeing a similar trend in the second quarter where you saw a slight pull off in your loan portfolio pipelines. You can feel free to email me your experience. But when we look at the non-current loans, we've seen just not much of an increase in terms of the non-current loans, just up to 0.53 from where it was last year at 0.52. So we don't see that credit situation coming about, but we do want to continue to keep an eye on this as we look forward into 2020 to 21, potential recession. Not to say that we're calling for one, but the probability has been increased in here. So we're going to keep an eye on these credit scores. Overall level of provisioning expense to average assets, you can see just at above that 0.1% in terms of average assets. So this has been solid, very, very consistent. Nothing kind of jumping out showing that the banks themselves have been perceiving additional risk inside their portfolios. On the efficiency front, with the net overhead, we're moved back down to that 2.1% from where we were in the first quarter at 214, and similar to where it was back in 12 months ago at the second quarter of 2018 at that 210. Now, when we look at the contributions here, we can see non-interest expense here at that 280 and non-interest income at 0.59. So a little bit of a deterioration on that non-interest income year over year. You can see dropping from 0.6 down to 0.59. So just something that we want to try and develop ways to garner more non-interest income. That is what's going to help us as we move into this margin compression. And as far as the non-interest expense, continue to find ways to become more efficient in our processes, or overall just grow the bank in terms of assets with the infrastructure that you have in place. That leading to the overall level of net tax burden. Tax burden overall at that 21%, which is where we've consistently seen that throughout the past 12 months. Efficient in terms of taxes, we would say a highly efficient institution with the tax burden would be around 16% or below. So we do have some wiggle room here with that new tax law, this has benefited financial institutions. In terms of that total risk for our benchmark group, we can see overall risk came down slightly, but we've been very consistent when we're looking at that median level. When we look at the 4 different categories of risk, the only thing that really jumped out was the fact that you saw liquidity risk increase slightly quarter over quarter, and the capital risk continues to move down as we retain capital. And that credit risk staying relatively the same, up slightly from where we were last year, but it's just ever so slightly, nothing to be concerned about. We do like to see all the risk categories below that 50 mark, and we continue to see that in here. That's what we have for you today. We look forward to talking to you next week when we look at the interest rates in the market that we're in. Have a great day, everyone.